Hey everyone, and welcome. Today, we're going to break down a word you hear all the time in the business world, liabilities. Now, I know, it might sound like some dry accounting term, but it's actually the key to understanding what a company truly promises and what it's capable of. So, let's get into it. So, let's just start with a really basic question. When you think about any business, could be your local coffee shop, could be a huge tech company, what does it actually owe to the world? Answering that is the very first step to seeing its true financial picture.
And to get to that answer, we've got to start with the absolute basics. So let's ask, what exactly is a liability?
At its heart, it's pretty simple. A liability is basically a claim on a company's money and resources. It's a running list of everything it owes to other people or organizations. Whether that's a bank, one of its suppliers, or even its own employees, a liability is a financial promise that the business legally has to keep. Okay, but you can't really get a handle on what a liability is without talking about its total opposite. This brings us to probably one of the most fundamental ideas in finance: assets versus liabilities. They are truly two sides of the very same coin. And this, right here, is the core financial balance of any company. On one side, you've got assets. That's all the stuff a business owns that helps it make money. We're talking cash, equipment, buildings. And on the other side, you have liabilities, which is what you owe. It tells the story of how you paid for all those assets. It's that constant balance between what you have and what it took to get it. But here's where it gets a little more interesting, because not all debts are created equal. We can actually sort a company's liabilities into two very different piles, and doing that tells us a whole lot about its financial health. And the biggest difference between them? It's just time. Current liabilities are the short-term debts, the ones that have to be paid off within a year. You can think of these as the company's immediate bills that are always coming due. Then you have long-term liabilities. These are the bigger debts that are paid off over a much longer period, representing those major financial commitments. So let's look at some real-world examples to make this stick. Over in the current or short-term column, you've got things like paying employee salaries and, of course, taxes. Accounts payable is another really common one, and that sounds fancy, but it's just the money a business owes to its suppliers. On the long-term side, you see the heavy hitters, like big business loans or a mortgage on an office building, things that get paid down over many, many years. Okay, so we've defined liabilities, we've sorted them out by time, but what's the actual bottom line? Why does any of this really matter for a business? It all boils down to this one simple idea. Liabilities represent the financial responsibilities of a business, and understanding them is absolutely critical because it shows you all the promises a company has made, and these are promises it has to keep if it wants to survive, let alone grow. And that leaves us with one last, and maybe the most important, question to think about. If liabilities are all about what you owe, then how do they end up shaping what you can actually build? How do these financial promises affect a company's ability to take risks, to innovate, and to grow in the future? That, right there, is the power of understanding the balance sheet.